I used to do consulting work for a bank and saw numbers that people like us are not supposed to see, real estate portfolios specifically, which was a big part of what that bank does with the money people deposit in their accounts. And for a while, I got to see the back end of those portfolios. The numbers didn't add up, not in the way you'd expect. Their real estate deals were clearing 5% to 8% a year in profit on the full size of the deal. My own checking account, same bank, was paying me 0.2%. My high-yield savings, same bank, sat at 1%. Factor in inflation, and the money in my account wasn't growing. It was shrinking every single month while they compounded my money into someone else's fortune. The system isn't broken. It's built to reward whoever understands it, and almost nobody bothers to learn the two numbers that decide which side of it you're on. By the end of this, you'll know the same two numbers that let real estate investors finance their way from almost nothing to 7 figures a year, using the bank's own money against it. You don't need to have worked inside a bank to know this feeling. You've checked your own account at some point and felt that quiet letdown, the number that's basically nothing, and you let it go, because there didn't seem to be anything to do about it. Not because you don't care about money, because nobody ever showed you what that number was actually supposed to be measured against. This isn't an old story I'm telling you. It's happening in your account today. On June 17, 2026, the Federal Reserve held interest rates steady for the fourth time in 2026. The federal funds rate sits between 3.50% and 3.75%. That rate is the reason the prime rate, the rate banks use as the floor for what they charge to lend, sits at 6.75% right now. Meanwhile, the FDIC's own national survey shows the average American savings account is paying 0.38% APY, not 3.8%, 0.38. That's not two separate numbers. That's the same dollar priced two different ways, depending on which side of the counter you're standing on. This gap isn't new either. It's existed for as long as banking has existed. What's different is just how visible it is right now, with the Fed holding steady and prime sitting exactly where it is this week. Here's the thing, people get wrong when they get angry about this. The bank isn't smarter than you. It's not some genius trading desk outsmarting the public. It's running the same logic a casino runs. A casino doesn't need to win every hand. It doesn't even need a big edge. It needs a small, guaranteed edge, run across enough volume, enough times, that the math stops being luck and starts being inevitable. That's the entire business model, not genius. Volume. A bank's margin on your money, the gap between what it pays you and what it charges someone else for the same dollar, is the exact same kind of edge, small per dollar. But run across hundreds of millions of accounts every hour of every day, it stops being small. And it doesn't even need every single loan to work out. Some borrowers default, some accounts cost more to service than they're worth. The bank's edge isn't that it's right every time. It's that across enough loans, enough accounts, enough months, the wins outweigh the losses by a predictable, repeatable amount. That's the part an individual chasing one big trade can't replicate. The bank isn't betting on a single outcome. It's run the same trade so many times that the outcome has basically stopped being a bet at all. Picture it small first. A 1 percentage point margin on $5,000 is $50 a year. Nothing. Now hold that same margin across 10 million accounts averaging that balance, and 1 percentage point alone is 500 million. Banks aren't holding a 1-point margin right now. They're holding closer to 6. In the first quarter of 2026 alone, FDIC-insured banks in the United States reported $80.5 billion in net income, not revenue, profit, in 3 months. That's what a tiny margin looks like once you multiply it by enough volume and enough speed. And once you see that, you can't unsee it. It's not just banks. It's everywhere, once you know to look for it. Take a lawn care business, strip away the trucks and the mowing and zoom all the way out, and it's just capital in, capital out. Say you put in $100,000 over a year, a new hire, a new truck, fuel, insurance, everything that comes with running it. If that move only brings in $100,000 back, you didn't make anything, you just moved money in a circle. But if it brings in $150,000 in revenue, you cleared $50,000 on $100,000 spent. That's a 50% return. No savings account on earth pays that, because a savings account has no risk and requires no skill. A business has both. Now, take an online business running paid ads. Same formula, same 50% class return is realistic if the offer and the ads are good, but instead of waiting a year to find out, You find out in days. Spend on ads, see what comes back, repeat. Now take something simpler, buying and reselling like sneakers or watches. Say you buy something for $1,000 and sell it for Beatty's $100. That's a 10% markup, not exciting on its own. But say you do that exact same trade 5 separate times in 1 year, same $1,000, flipped 5 times. You didn't make 10%, you made 50% on the same starting capital because you didn't just earn a margin, you earned it 5 times. The second move, doing it again and doing it fast, is the part almost nobody accounts for when they look at a deal. Every single example so far, the bank, the lawn care business, the ad-funded digital product business, the flipping side hustle, comes down to exactly 2 numbers. How big is the margin you make per cycle? And how many times you can repeat that cycle in a given period. Margin times how often you repeat it. That's the whole formula. And it explains the bank too. Its margin per dollar is tiny, a few percentage points. But its velocity is constant. It never stops. Every hour, every account, all at once. Tiny margin, run at enormous velocity, becomes $80.5 billion in a quarter. Notice the 2 earlier examples don't get there the same way. The lawn care business is margin heavy and slow, 1 big cycle a year. The flip is margin light and fast, 5 cycles in the same year. Both land around the same return, because the formula doesn't care which dial you turn, as long as one of them is strong enough to carry the other. Got capital but not much time? Lean on margin. Got time and hustle but not much capital? Lean on velocity. Most people only ever look for one and assume the other doesn't matter. It's the only reason a $100,000 real estate deal and a $1,000 flip can produce the exact same percentage return, despite looking nothing alike on the surface. Here's where most people who watch rich people use debt content get hurt. Leverage does not create a margin. It multiplies one that already exists. If you borrow $100,000 and put it into something that returns less than what the loan costs you, leverage doesn't soften that. It accelerates it. You lose faster, not slower. The bank gets to run leverage safely because its edge is guaranteed before it ever lends a dollar. It's not gambling on whether the spread exists. It already knows it does. It's set the price on both sides. It also has entire departments whose only job is pricing exactly how risky a loan is before it's approved. An individual borrowing money to chase a margin they haven't actually proven yet is doing something completely different. They're not running the bank's trade. They're betting they can find the bank's trade with someone else's money before they've ever tested it with their own, usually without the first idea of how to price the risk they're taking on. That's the part the how the rich use debt videos leave out. The debt was never the secret. The proof came first. This isn't theoretical either. It's the entire 2008 financial crisis in miniature. Banks and investors leveraged real estate on the assumption that home prices would keep climbing forever, which meant the margin they were counting on was never actually proven. It was assumed. When prices reversed, the exact same leverage that would have multiplied their gains multiplied their losses instead, at a scale that dragged the global economy down with it. The mechanism that builds fortunes and the mechanism that destroys them is the same mechanism. The only variable is whether the margin underneath the leverage was ever real to begin with. There's a version of this exact same formula that the wealthiest people in the country use, and it has a name. Buy, borrow, die. Step 1, buy an asset that's likely to appreciate: stock, real estate, a business. Step 2, instead of selling it when you need cash, which would trigger a tax bill, you borrow against it. Loan proceeds aren't taxable income. You get the cash, the asset keeps growing, and as long as the asset appreciates faster than the interest on the loan, you come out ahead doing nothing but holding it. Step 3, when you die, your heirs inherit that asset at its current value, not what you originally paid. Under Internal Revenue Code, Section 1014, the basis steps up to today's price, and the gain that built up your entire life is never taxed at all. ProPublica's 2021 investigation into IRS records found the 25 richest Americans paid a true tax rate of about 3.4%, almost entirely because of strategies built on exactly this. It's the same trade as the bank. Borrow against something at a rate lower than what that something earns you and pocket the difference. The bank does it with your deposit. They do it with their own stock. You don't need to be a billionaire to use a smaller version of it. Securities-based lines of credit and home equity lines of credit run on the exact same logic. Borrow against an asset you already own, at a lower rate than that asset is appreciating instead of selling it. It's common enough now that securities-based lending at some of the largest wealth management firms in the country grew by 50% or more between 2019 and 2022. The mechanic isn't exclusive to billionaires. The margin underneath it still has to be real first, which is exactly why the last beat matters before you ever try it. And the rate you'd have to beat is the same one from the start of this video, prime, sitting at 6.7% this week. That's the bar. Below that, borrowing to invest is how you lose money faster. Above it, consistently, is the entire game. So, why doesn't everyone just go do this? Why is a savings account still where most people's money sits? Part of it is math. The margin has to be proven before it's safe to lever. But part of it is something psychologists have actually measured. Daniel Kahneman and Amos Tversky, the researchers who founded the field of behavioral economics, found that losses hurt roughly twice as much as identical gains feel good. Losing $1,000 feels worse than gaining $1,000 feels good, by about double. That means the zero-risk option, the savings account, the 0.4%, feels emotionally safer than it actually is, and the higher margin option feels riskier than its real odds, because your brain is built to weigh the downside heavier than the upside, every single time. That same research explains something else too. Once you already have something, even a mediocre 0.4% return, giving it up to chase something better feels like a loss, even though staying put is its own kind of loss, just a quieter, slower one. Psychologists call it the endowment effect. You value what you already hold more than it's actually worth, simply because you already hold it. It's a large part of why so much money just sits exactly where the bank wants it to. But that 0.4% baseline isn't neutral. It's the price of taking zero risk and needing zero skill. Every point of return above that baseline is payment for something. The lawn care owner is paid for the risk of the business failing and the skill of running it. The flipper is paid for knowing what to buy and where to sell it. The real estate investor financing a deal with almost no capital of their own is paid for clearing a barrier most people can't. The relationships, the experience, the access to that kind of financing in the first place. That barrier isn't always money either. Some of the investors I mentioned earlier didn't start with cash. They started with a willingness to do the unglamorous parts other people wouldn't. Finding the deal, managing the renovation, structuring the financing, sometimes bringing in a partner who had the capital while they brought the work. The capital came from someone else because they'd already proven on something small that they could run the formula correctly. That's the actual barrier most people never clear. Not money, proof. That's the actual question buried under all of this. Not, which business should I start? It's where can you find a margin worth repeating, and what are you actually being paid to clear? The vehicle never mattered. Real estate, a course, a flip, none of it was ever the point. What mattered, every single time, was whether the margin was real before anyone added leverage or speed to it. Most people who try to copy the rich use debt skip that step entirely. They borrow first and hope the margin shows up later. The bank never does that. The investors who actually made it from nothing never did either. They proved it small, then they made it fast, then, and only then, they made it big. The bank isn't going to tell you any of this. There's no reason for it to. But now you know the same two numbers. It's been running on your money the entire time. And you know exactly what you'd need to prove on a small scale before you ever tried to run them yourself.